So if you're looking to invest in commercial real estate today, with all the uncertainty in the market and the fate of many businesses and jobs up in the air until further notice, it's now more important than ever to analyze your risk metrics on a real estate deal. But if you're looking to get into the game right now, what are the specific deal metrics that you should be paying closer attention to than normal today in order to protect your downside and maximize your potential upside in your next real estate investment? Well, if you're thinking of investing in real estate in 2020, or you're preparing for a job interview where you might be asked a question like, what would you look for in an attractive investment today? In this video, we'll cover 4 key points that you should be aware of when heading into any transaction in our current economic landscape today. Hey, this is Justin from breakintocre.com, and if you're new here on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first real estate deal, make sure to subscribe and hit the notification bell so you don't miss any new videos as soon as they're released. Now, when you're underwriting a potential real estate acquisition, you're essentially using current and historical data to make assumptions about future performance on a deal in order to project out what you believe to be the likely cash flows on the deal based on those assumptions. And while no one has a crystal ball and no one can bat 1,000 when it comes to accurately predicting cash flows and returns, there are some big deal metrics that are more important than ever to look at today when you're underwriting potential real estate investment opportunities. So the first and possibly most important on this list right now is the debt service coverage ratio, or DSCR, on the deal. Now, we've covered this concept a lot on this channel, but the DSCR essentially measures how many times over your NOI, or net operating income, can cover your required debt payments on an annual basis. And today, it's more important than ever to make sure that this number provides you with an adequate cushion to make sure that if vacancy spikes suddenly, or rents drop at the property, or you start to see collections issues like many landlords have been seeing today, that you'll still be able to service debt from operating income and you won't have to dip into your own pocket to pay the lender. Now, a good way to calculate how much cushion you have in your NOI is to take the number 1 and divide that by your debt service coverage ratio on the deal. And if you take the number 1 again and subtract that number you just calculated, you'll get the percentage decrease in your NOI that you'll need to see before that net operating income will no longer cover the debt payments that you'll need to make to the lender every month. And why the DSCR is more important than ever today is because this metric takes into account net operating income rather than just factoring in rent decreases or vacancy increases at the property. And this is so important today because many property types are seeing pressure from both sides of the income statement on both the revenue and the expense side of the spectrum. So many property owners are seeing revenue decreasing while at the same time seeing operating expense loads increasing as heightened cleaning and sanitation standards are creating an unexpected increase in maintenance costs to accommodate new safety requirements on commercial properties. Now, traditionally, at 65% to 70% LTV ratios, many lenders were looking for about 1.2 to 1.35 times DSCRs for many stabilized properties. But even at a 1.35 DSCR, the NOI would only have to drop about 26% before you start to get into negative cash flow territory. So as a borrower going into a deal today, you may want to factor in some extra cushion that brings up your DSCR up even higher than traditional levels, either by decreasing your loan amount to decrease your payment, or negotiating a prolonged interest-only period to help that DSCR in the early years of the hold period when income might be bumpy as the ripple effects of economic shutdowns continue to be felt long-term. Now, aside from taking a look at your loan metrics, as far as the operations of the property are concerned, another key metric that is now more important than ever is the weighted average lease term at the property, often referred to as WALT. And the weighted average lease term will tell investors the weighted average remaining contractual lease obligations of current in-place tenants based specifically on the square footage that each tenant occupies. So for example, let's say you're analyzing a property with 2 tenants, one which occupies 7,000 square feet and has 3 years of lease term remaining, and one which occupies 3,000 square feet and has 10 years of lease term remaining. And using this example, since tenant number 1 occupies 70% of the rentable area at the property and tenant number 2 occupies 30% of the rentable area at the property, the weighted average lease term would be calculated by taking 70% times 3 years plus 30% times 10 years, which would give you a weighted average lease term of 5.1 years at the property. Now, this is extra important in today's environment, especially when looking at short-term lease risk on a deal. So with the economic conditions going on right now, deals with a smaller weighted average lease term present significantly more risk to investors because the risk of tenants vacating in today's environment is significantly higher than it was a year ago, and likely higher than it will be a few years from now once the economy is stabilized. And this is because if a tenant vacates a commercial property today, with US GDP expecting to see a drop of 40 basis points in 2020, according to UCLA, it's likely that once a suite is vacated, that suite is likely going to sit vacant for an extended period of time right now. And in a scenario where the property owner is fortunate enough to lease up that suite quickly, or that existing tenant decides to renew, it's extremely likely that that landlord will still be required to lease up that space at rental rates that were below the rental rates paid in the previous lease. This is especially important for properties that lack tenant diversification and only have a small handful of tenants occupying the entire property. So single tenant net lease properties are especially susceptible to risk here because if that tenant doesn't decide to renew, that property owner could be on the hook for significant property tax, insurance, and maintenance costs, and also require loan payments for many months or even years before that space is generating income again. Now, as far as an ideal weighted average lease term is concerned, there isn't really a rule of thumb here to shoot for, but with very few economic forecasts pointing to a full recovery before late 2021 or even 2022, at least 2 to 3 years of weighted average lease term remaining right now would give the economy more time to recover before lease negotiations begin with existing tenants at your property or potential new tenants that would be backfilling a space. Now, aside from your going in DSCR and your weighted average lease term, you'll also want to take a closer look than normal right now into some of your main key investment returns. And for most investors, the internal rate of return, or IRR, is an extremely important return metric to measure and takes into account operating income, but also loan proceeds, loan payoffs, and any sort of sale proceeds you expect to achieve on the deal. But with so much uncertainty around property values right now, and with many investors still scratching their heads about what market pricing actually looks like today, making investment decisions based on primarily projected sale value in today's market can be a very risky proposition to get into. So as part of that IRR analysis, investors can layer on an additional level of analysis within that IRR calculation by doing what's called partitioning the IRR. And this allows investors to calculate what percentage of the projected returns are coming from ordinary operating cash flow and what percentage of those returns are coming from sale proceeds. And to do that, investors can separate out operating cash flow from net sale proceeds in their financial model and then take the net present value of each of these individually, discounted back at the project level IRR that you calculated on the deal. So for example, if you're analyzing a property with a 15% IRR and the NPV of the projected cash flow from operations on the deal, discounted at that 15% IRR, comes out to $300,000, and the NPV of the projected cash flow from net sale proceeds, discounted at that 15% IRR, comes out to $700,000, then 70% of your projected IRR in the deal would be coming from your sale proceeds at the property. Now, the higher your percentage of returns coming from the sale, the more inherent risk you have of not hitting the returns that you're promising to investors. And the reason why this is the case is because sale proceeds tend to be much more speculative than current operating income being generated on the deal. And this is especially true for projects with a short-term hold horizon, since these projects are generally very capital intensive to turn the property around quickly or to develop the property quickly, which results in very little operating cash flow, and the majority of that investor cash flow coming from projections around what the sale price of the asset might be. And with so much changing today in the CRE investment landscape, it's tough to say with much certainty what cap rates or valuations will look like 3 to 5 years down the road from now. So the less reliant a deal is upon future sale projections and the more reliant a deal is on current operating cash flow to hit returns, the less inherent risk there tends to be for investors on the deal. And finally, once you partition the IRR, calculated the weighted average lease term, and know your debt service coverage ratio on the deal, the final thing that I would pay extra attention to today is the property tax reassessment schedule in the area that the property that you're analyzing is located. So with so much federal and state assistance being issued to keep people afloat during these times, that money is at some point going to need to come from somewhere. And raising property taxes is a quick and easy way for a city or a state to raise money in times of need. Now, for properties with triple net leases where tenants reimburse property taxes, and for cities and states where the schedules of property tax reassessments are clearly defined, this is likely going to be less of an issue, but for areas with undefined property tax reassessment schedules and properties without tenant reimbursements for property tax expenses, this could be a major issue for landlords down the road if property tax rates are increased or a property is reassessed unexpectedly. Especially for product types like multifamily that don't generally charge property taxes back to the tenant, a big increase in property taxes means an equally large decrease in net operating income, which in turn means decreased cash flow, lower property value when you go to sell the deal, and lower valuations if you're looking to refinance the property at some point in the future. Now again, it's impossible to tell if or when this might happen, but lack of clarity around reassessment schedules exists in many US states, so the less clarity you have on deals where you're 100% responsible for operating expenses as the landlord, the more exposed you'll be for an unexpected property tax hike in the future. So there are endless amounts of things you can analyze on a real estate deal, but if you're looking to acquire a property this year, these are 4 things that you may want to take a closer look at before making an offer on your next potential purchase. Now, if you want to learn how to incorporate things like the weighted average lease term and IRR partitioning into your real estate financial models, make sure to check out the Advanced Real Estate Pro Forma Modeling Masterclass, which walks through how to partition your IRR, how to build dynamic weighted average lease terms in Excel, how to dynamically model property tax resets, and many more advanced analysis features that will be really helpful when you're underwriting new acquisition opportunities in the economic environment we're seeing today. And if you want to learn more about the key underwriting and financial analysis principles behind property valuation and what you should be looking for when analyzing deals in general, make sure to check out Break Into CRE Academy, which will give you access to all Break Into CRE courses, all real estate financial models, and some additional one-on-one support from me. So I hope this was helpful if you're looking to buy a deal this year or just preparing for an upcoming interview. If you like this video and want to see more content like this, make sure to let me know by hitting the like button, subscribe to this channel, and share this with anyone else who might find this helpful. Also, make sure to leave a comment below and let me know what investment return metrics you are taking a closer look at in your underwriting today. So thanks so much for watching. I hope this was helpful, and I'll see you in the next video.